Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we perform a deep forensic breakdown of Leonardo DRS, trading under the ticker DRS.
Leonardo DRS is executing an aggressive defense technology monetization playbook, leveraging its specialized sensor and propulsion monopolies to insulate its record $8.4 billion total backlog from broader industrial volatility. However, this best-in-class compounding thesis is currently trading at an aggressive trailing valuation multiple of 38.8 times earnings, making it highly sensitive to near-term supply chain constraints and seasonal working capital cash drains.
Yeah, so let's unpack that for you. When you hear the phrase defense contractor, your mind probably jumps straight to those massive headline-grabbing platforms, right?
Like fighter jets or tanks.
Exactly.
Yeah.
You picture the heavy steel hulls of submarines or the sleek airframes, but Leonardo DRS, they don't actually build any of those things.
No, they build the highly classified, almost invisible technology that goes inside them.
Yeah, we're looking at a company that manufactures the advanced sensors, the tactical computing networks and electric propulsion systems, stuff that actually makes those multi-billion-dollar machines smart and lethal. So this deep dive is taking you straight into the financial mechanics of modern warfare.
I mean, we are analyzing a subsystem provider here, not a prime platform builder. And to truly understand why this company commands that premium 38.8 times earnings multiple I mentioned, we have to grasp the specialized nature of their products.
Right, so where do we start with that?
Well, we need to look closely at their Advanced Sensing and Computing Division, or ASC. In the defense ecosystem, DRS essentially acts as the eyes, ears, and brains of the battlefield.
Okay, so when we say eyes, we're talking about their gold standard forward-looking infrared or FLIR systems, right?
Yes, exactly. These are cooled and uncooled thermal sensors.
And they allow forces to target threats through total darkness, heavy battlefield smoke, dust storms, even sophisticated camouflage.
But it isn't just vision. It's total situational awareness. They build tactical air defense radars that track incoming artillery and low-flying threats in real time.
All tied together by their ruggedized combat computing networks.
Right. And to take that a step further, look at how they are evolving those computing networks. It's no longer just about displaying a radar blip on a screen for a human operator.
Right, they have that newly released THOR Edge platform.
Yeah, THOR is an open architecture, rugged chassis designed specifically to deliver high-density processing right at the tactical edge.
Oh, wow.
And when you combine THOR with their Sage Core software, you get native support for artificial intelligence operations and multi-sensor data fusion.
Multi-sensor data fusion. Okay. So it takes raw, chaotic data from disparate sensors across the battlefield and just instantly converts it into actionable intelligence.
Exactly.
So it sounds like, well, other defense contractors are building the skeleton and muscle of the military, but DRS is building the central nervous system.
That's a great way to put it.
But I do want to push back a bit here. Phrases like AI at the tactical edge and multi-sensor data fusion, they sound suspiciously like buzzy defense tech marketing bingo to me.
Sure, I get that.
Is there a specific tangible macro shift actually driving the financial demand for this central nervous system, or is it just corporate fluff?
That is the pivotal question for any investor looking at this space. The answer lies in how the nature of warfare has fundamentally shifted over the past 3 years.
How so?
Well, we are witnessing a massive proliferation of low-cost asymmetrical threats. Consider autonomous drone swarms or one-way loitering munitions.
Right, those are relatively cheap weapons, right? Like sometimes costing just a few $1,000s.
Exactly. And they can easily disable a $100 million traditional platform if it isn't properly defended.
Ah, I see the problem. So the heavy armor of a tank or the thick hull of a ship, it just isn't enough anymore if a swarm of cheap drones can overwhelm it from above.
You cannot just armor your way out of a drone swarm. Because of this terrifying reality, integrated kinetic and electronic warfare suites are no longer viewed as optional, nice-to-have upgrades.
Or mandatory.
Yeah, they are non-discretionary requirements by the Pentagon and global militaries. The defense budget requests aggressively prioritize layered air defense and counter-UAS systems.
So DRS's portfolio aligns perfectly with this exact macro shift. It turns their technology into a mandatory requirement for platform survival.
Precisely.
Okay, so they have the battlefield covered in terms of sensing aerial threats and neutralizing them on land. But to justify that massive valuation multiple, they need something entirely unshakable, right? Like, where is the actual physical manufacturing monopoly?
Well, that brings us from the Advanced Sensing and Computing Division over to their Integrated Mission Systems Division, or IMS.
Okay.
This is where we find their multi-decade naval mode operating deep beneath the ocean.
So this is where DRS moves from the brain of the platform to the raw physical power distribution and propulsion. And the crown jewel here is their position on the U.S. Navy's Columbia-class nuclear ballistic missile submarine program, which is the Navy's absolute top priority shipbuilding program.
It is. And crucially, it's the first modern U.S. electric drive submarine. The technological leap there is significant.
Because traditional nuclear subs use a mechanical drive, right?
Right, which involves physical gears connecting the steam turbines to the propeller. And gears create friction, and friction creates noise.
And in submarine warfare, noise is death.
Exactly. An electric drive eliminates those mechanical gears using electricity to power a massive motor directly attached to the shaft. It makes the submarine infinitely quieter.
And here is where it gets really interesting for you as an investor. DRS isn't just a supplier for the submarine.
No, they are the sole source provider of the permanent magnet electric propulsion motors for the Columbia class.
Wow. So they have an absolute monopoly on the critical propulsion technology for the most elite, secretive submarine in the world.
Yes, and that sole source status acts as a massive financial shock absorber for the company.
Right, because when you're the exclusive provider for a program of this scale, you benefit from a highly predictable, steady production cadence.
Exactly. It insulates you from the typical boom and bust cycles of defense procurement. The Navy is not going to suddenly stop building its nuclear deterrent.
And they physically cannot build it without DRS's specific permanent magnet motors.
Yeah.
Which is why we're already seeing the direct financial impact of that monopoly flow through to their bottom line, right?
Oh, absolutely. Looking at their Q1 2026 results, that operational efficiency and steady production cadence on the Columbia class drove an operating margin expansion for the IMS segment.
Right, all the way up to 12.5%.
And management made it very clear that this wasn't just a one-off quarterly beat.
Right. This establishes a highly profitable revised baseline for the entire IMS segment going forward.
The efficiency they've achieved on the Columbia program is now the standard. But, monopolies and high-tech moats are only great in theory.
Right. The real test is how they translate into actual bulletproof revenue.
Exactly. Defense budgets are notoriously fickle, so we need to look at how DRS tracks its incoming orders and specifically its backlog.
So let's talk about that inbound book-to-bill velocity, because the numbers here are frankly staggering. For 17 consecutive quarters, DRS has reported a book-to-bill ratio at or above 1.0 times.
It really is impressive.
Let me translate that for you. For every single dollar of revenue they bill and recognize, a new dollar of legally binding demand comes in the door. 17 quarters of that means they are constantly replenishing their revenue pipeline faster than they can drain it.
It is an unmatched streak of inbound velocity in this space. But to truly understand the quality of that pipeline, we have to perform a forensic accounting audit on their reported backlog.
Okay, let's dig in.
In their Q1 2026 filings, they reported a total backlog of $8.4 billion. But the metric we really need to focus on is their funded backlog, which stands at $4.68 billion.
Yeah, I was amazed when looking at how they calculate that $4.68 billion figure. I mean, they don't just lump everything together to make the number look as big as possible to Wall Street.
No, they use incredibly strict, conservative guardrails. The structural integrity behind this number is what sets DRS apart from many peers.
Right. They utilize a strict funded-only accounting guardrail.
Exactly. This means they completely exclude unexercised contract options. And furthermore, they completely exclude the unfunded ceilings of multi-year contracts.
So if Congress hasn't explicitly appropriated the funds, they just refuse to count it.
Exactly. If the funds aren't legally obligated to a specific task order, DRS refuses to count it in that $4.68 billion metric.
So it's basically the difference between someone saying they, might buy your house next year versus someone handing you a non-refundable, legally binding cash deposit today.
That's a perfect analogy.
By keeping those unexercised options out, this baseline represents a solid, highly insulated manufacturing queue, not just hypothetical future options that could vanish if the political winds change.
Which is a vital distinction when you consider the deeply political nature of defense spending. To truly grasp how this conservative accounting plays out in reality, We need to look at the mechanics of contract conversion.
Like how massive government contract awards actually flow through DRS's books day to day.
Exactly.
Okay, this is a great exercise. Let's look at the recent deal they won to produce the Distributed Aperture Infrared Countermeasure System, or DRCM.
Right, DRCM.
This is a multi-year aircraft survivability countermeasure deal worth $533 million. Now, logic would dictate that winning a $500 million contract means the funded backlog immediately jumps by $533 million.
Well, logic would lead you astray in government contracting because this specific award is an indefinite delivery, indefinite quantity contract, or an IDIQ. And because it's an IDIQ, zero funds hit the funded backlog at the time of the award. Nothing.
Wait, I have to stop you there. They win a $500 million contract, put out a press release, and zero funds are immediately booked. How is that even remotely accurate?
It is fiercely conservative, but it reflects reality. An IDIQ contract essentially establishes the rules, the pricing, and the maximum ceiling for future orders.
So it doesn't guarantee a specific volume up front.
Exactly. Therefore, zero funds enter the funded backlog until the Navy and Army explicitly fund incremental, fully appropriated task orders under that umbrella.
Wow. So as the CFO noted on the call, they haven't even started to see the order flow come through on that DRCM contract yet.
Right, meaning that entire $500 million represents pure future upside, not yet reflected in the funded backlog.
Okay, I understand the IDIQ reality now. Let's contrast that with another recent win, their Army Thermal Sensor Modification contract.
Yeah, let's look at that.
So this is to supply advanced FLIR sensors for combat vehicles, and the headline number was roughly $150 million.
Right, and this one functions very differently. Unlike the IDIQ, this is a modification to an existing program.
Okay.
However, even with a $150 million headline number, only $20.2 million in fully appropriated funds were actually allocated by the Army at the time of the award.
So following their strict guardrails, only that $20.2 million enters the funded backlog today?
Exactly. The remaining $130 million sits out in the cold in the unfunded backlog until Congress formally appropriates it.
But once that money is funded, how does it actually turn into recognized revenue on the income statement? I mean, they don't just wait until 2029 when the contract ends and recognize it all at once, do they?
No, definitely not. For these long-term production contracts, DRS utilizes the strict percentage of completion cost-to-cost method.
Let's translate that out of textbook accounting jargon for everyone.
Sure. It essentially means revenue and profit are recognized continuously over time as the actual manufacturing costs are incurred.
Oh, I see. So if they complete 10% of the engineering and raw material labor this quarter, they recognize 10% of the revenue.
Exactly. It directly ties their financial reporting to the physical reality on the factory floor, continuously through 2029. You only recognize $1 of profit when you actually spend the labor and materials to earn it.
That highly disciplined approach to revenue recognition naturally leads us to their capital structure. When you map out their balance sheet, it reveals a very unique, pristine capital allocation strategy.
Pristine is a good word for it. They are operating a completely debt-free balance sheet.
Yeah, they entirely extinguished their remaining term loan A obligations, and they are sitting on $328 million in net cash.
Finding a defense contractor of this size carrying zero debt is incredibly rare. It grants them massive strategic agility.
They have the dry powder to execute strategic tech acquisitions or ramp up internal R&D.
Right, or return capital to shareholders without constantly worrying about servicing high-interest debt.
But I was digging into their cash flow statement, and I found something that seems like a massive contradiction.
Oh, what did you find?
If they are so profitable, their margins are expanding, and they are totally debt-free, why did they report a seasonal $95 million first quarter free cash outflow?
What?
Like, how do you bleed nearly $100 million in cash in a single quarter when you're making record profits? Did someone lose a bet?
That is a phenomenal catch, but no one lost a bet.
Yeah.
That outflow is not a sign of distress. It highlights a fundamental reality of the defense industrial base.
Okay, then what is it?
It is a normal structural feature of defense contracting. You are looking at a heavy working capital ramp.
A working capital ramp?
Yeah, in order to build highly complex systems like tactical radars or nuclear submarine motors, DRS has to burn cash up front to secure raw materials, specialized components, and engineering labor.
Oh, long before the government milestone collections are actually realized and paid out. Oh, I see. So they have to front the cash to buy the specialized optical glass and the semiconductors today, and they might not get the massive check from the Pentagon until the system passes testing months down the road.
That is the exact mechanism. It creates a highly seasonal cash flow profile. The first quarter often sees a massive outflow to fund future growth, and the cash collections heavily weight toward the back half of the year once those deliveries are completed.
Okay, that perfectly explains the cash mechanics. But there is an absolute elephant in the room regarding their corporate structure that we have to address, and frankly, it's the biggest red flag for me.
I think I know where you're going with this.
DRS is an American defense contractor. They are building the electronic brains for U.S. tanks, and they're building the classified permanent magnet motors for U.S. nuclear ballistic missile submarines.
Yes.
But Leonardo DRS is majority owned by Leonardo SPA, which is an Italian conglomerate.
Correct.
How on earth is that legal? Are we just handing our nuclear sub-blueprints to a foreign entity?
The concern is entirely valid, and the answer lies in a highly structured, legally binding proxy agreement with the U.S. Department of Defense. This agreement creates a definitive legal proxy firewall around DRS.
So it is an insulated asset.
Completely insulated. Under this proxy firewall, the Italian parent company, which owns 71% of the equity, is allowed to reap the financial rewards.
They get the economic benefit of the revenue and the profits.
Yes. However, they are legally and physically banned from accessing any of the classified blueprints, technical data, or secure facilities.
So the Italian executives get the massive dividend checks, but if they try to visit the factory, they basically have to sit in the lobby and read old magazines.
Essentially, yes.
Yeah.
To ensure this strict separation, DRS's daily operations and its board of directors are entirely controlled by cleared American citizens.
Usually retired U.S. military officers and defense officials with top-level clearances, right?
Exactly. This unique setup keeps DRS fully insulated as a pure-play U.S. national security asset, while still benefiting from the global scale and financial backing of a massive European aerospace conglomerate.
It is a fascinating hybrid structure. So we've spent this deep dive building the bull case. I mean, we are looking at a financially bulletproof, proxy-protected tech toll booth with a sole source submarine monopoly and a historically pristine backlog.
We have. But now it is time for the final verdict, and we need to clearly define the structural risks to your potential reward as an investor.
Right. The execution risks are material and must be weighed carefully against the growth story. Let me deliver the final investment evaluation with the summary analogy.
Go for it.
Think of Leonardo DRS as an elite technological subcontractor, hiding behind a protective proxy firewall, sitting perfectly positioned to tax the entire global defense modernization pool. I mean, they don't care if Lockheed Martin or General Dynamics wins the contract for the next vehicle, because whoever wins is going to need DRS's electronic brains to make it work.
That is the blue sky reward scenario, for sure. But the primary execution risk dragging on that scenario is valuation. We mentioned the aggressive 38.8 times trailing premium multiple.
Right, which basically prices the stock for absolute perfection.
Exactly. The severe threat here is multiple compression.
Multiple compression. Okay, break that down for the listener.
So if U.S. defense budgets slow down, or if the government simply delays appropriations due to political gridlock, that premium multiple could painfully and rapidly revert to standard peer baselines.
Wiping out your equity value even if the underlying business remains relatively stable.
Precisely.
Yeah.
And speaking of the U.S. government, we have to talk about customer concentration. This isn't some diversified commercial enterprise selling to thousands of clients.
Right. There is an intense 80% revenue dependency on a single customer, the U.S. Department of Defense.
Yes. If the Pentagon changes its priorities or delays a program, DRS feels it immediately.
Wow, 80%.
And that concentration risk is deeply compounded by their margin and supply chain risk. We noted earlier that 87% of DRS's revenue is tied to fixed price contracts.
Okay, which means while fixed price contracts allow DRS to keep the extra profit if they manufacture with high efficiency, the downstream effect is that DRS bears the entirety of the burden for cost overruns.
Right. If inflation spikes, they cannot just send the Pentagon a higher bill.
They eat the loss.
They eat the loss entirely. This creates near-term margin variability from volatile supply chain timings on specific raw material inputs.
Like what raw materials are we talking about here?
Well, for example, their advanced thermal sensors rely heavily on specialized materials like germanium.
Ah, germanium, okay.
Yeah. If global supply chains for germanium tighten or spot prices spike, DRS absorbs that cost directly.
which threatens the very margin expansion we discussed earlier.
Exactly.
The financial engineering is pristine, but the external macro dependencies are fierce. It leaves you with a lot to weigh. But before we go, I want to leave you with one final provocative thought to mull over.
Let's hear it.
We talked about how DRS is building the central nervous system for these platforms. Recently, DRS has been successfully testing its counter-UAS technology, its anti-drone systems on unmanned surface vessels.
Oh, taking the defensive technology off a manned ship and putting it directly on a robotic platform.
Exactly. We are entering an era where robotic platforms are actively out in the water protecting manned platforms.
That's a huge shift.
Right. So if the future of naval warfare shifts entirely to autonomous fleets, like swarms of unmanned ships acting as perimeters, how much larger does DRS's electronic toll booth become when the human element is completely removed from the platform? I mean, if everything is a robot, everything needs an electronic brain.
It suggests their addressable market could multiply exponentially as the platform itself becomes entirely electronic.
Something to think about as the nature of warfare continues to evolve.
Thanks for joining us on this deep dive.
Risk defined. Portfolio protected.